and CIO of Wilson Asset Management. Look, thank you all for coming today. There's a lot of familiar faces, and thank you for the new people that are coming for the first time. I think this is a record crowd here today. So we are here reporting to you as we do on a 6-monthly basis because you own the company, and we can only do what we enjoy doing because you allow us to do that. So on behalf of everyone at Wilson Asset Management, thank you for doing that. When I was here a year ago, we were in a significantly different situation. We were in a situation where money was being taken out of the global economy with quantitative tightening, and interest rates were increasing. And one of our focuses in terms of managing the money on your behalf is to not lose money. And at that point in time, with, say, our largest listed investment company, WAM Capital, we'd moved our cash levels up as a way of protecting your capital. Where we are today, it's a totally different environment. We saw the Federal Reserve do a total U-turn. We've got interest rates globally at record lows. We have money being pumped into the system. In the US, the Federal Reserve over the last 7 or 8 weeks has pumped about $240 billion into the system through the repo market. So QE4 has begun. And that's why in the US, money supply, if you look at the last 3 months' money supply figure, M2 is growing at nearly 10%. So we've got low interest rates and we've got money being pumped into the system. That's why asset prices are going up. In terms of looking forward, that globally we still have all the monetary authorities being very accommodative in terms of their current posture. So you'll hear from the other lead portfolio managers today up on stage, and what sort of makes me semi-nervous is looking forward for the next little period of time, we're all reasonably positive. We've also got to remember, this is the longest bull market in the US ever, and we all know that after bull markets are a bear market. So to me, you have to be cautious. And one of the things that we're trying to grapple with is everyone's focused on yield. And so a lot of money has been chasing yield. And so at some point in time, that pushes valuations to extreme levels. But it doesn't feel like we're just there yet. In terms of, I talked about the team, and a lot of people think, I do the hard work. I tend to make the noise. It's really our team that does the hard work. And actually, before we go there, I'll just put it down. Actually, where's the disclaimer? Can we go back one? Now that's so you can't. So we can only give general advice. So if you can read that, that protects us if you'd like to sue us. Thank you. In terms of the investment team, again, it's everyone there. We're very passionate about what we do. I'm very fortunate that the people who work with me are a lot smarter than me, and that's the team. You'll be hearing from the 3 lead portfolio managers today. Initially, Katrina Burns, she runs WAM Global and is doing a fantastic job. And Katrina, effectively what WAM Global is, it's WAM Capital, but looking for global stocks. Then you'll hear from Matt Halpt, who manages WAM Leaders, and really it's getting access to the biggest and best companies in Australia, but he manages it incredibly actively. So he adds adds good value. And then you'll hear from Oscar, who is the lead PM for WAM Capital, WAM Research, WAM Active and WAM Microcap. And that's really focusing on undervalued growth companies in Australia and buying them when we can see a catalyst is going to change the valuation. Otherwise, we'll sit in cash. When we're looking at buying undervalued growth companies, we always, for us, management is incredibly important. Like when you buy shares in our listed investment companies or the ones we manage on your behalf, then you are backing us as a manager. When we buy shares in a company, then we are backing management to perform for us and do the right thing. So, I mean, the interesting thing is when you look at our 6 listed investment companies, 4 of them are trading at premiums to NTA, 2 are trading at discounts to NTA. I'm a value manager. I have a fair degree of Scottish blood in me. I like buying, I'd like to buy $1 for, actually I'd like to buy $1 for 10 cents if I could. But I accept in the market you always don't get those opportunities. So I definitely like buying $1 for 80 cents or 90 cents or at least paying less than $1. And 2 of our listed investment companies that are our newer ones that are just in the process of their share registers to tighten up are trading at discounts to NTA. And that's WAM Leaders is trading about a 4% discount to NTA. We gave dividend guidance recently on that. So you're getting exposure to the largest companies in Australia, actively managed and with a yield of about 5% fully franked. And the other one is WAM Global, which is the newest member of the team. That's trading at about if you looked at the live NTA, about a 10% discount to NTA. And we've seen it before with WAM Capital. It's been going 20 odd years. I can see some original shareholders here. And for the first couple of years, we traded at a discount to NTA. So it just takes a little bit of time for the people that don't understand what they've invested in to decide to sell and leave, and for the people that understand what's there, to narrow that gap. So they're the 2 that we think are value. In terms of WAM Global as the biggest discount, I'm still relatively young, so yield isn't a big driver for me. That's probably. I wanted to finish the roadshow, but I'll probably buy a few after the roadshow, so everyone can have the opportunity first. In terms of one thing, when we started this roadshow, we actually flew to Toowoomba and we drove from Toowoomba to the Gold Coast, and when we drove across there, not only could we see the smoke. And in most capital cities that we've been to, there's been a lot of smoke from the bushfires. But driving cross-country in Queensland, when you looked out the car window, to me, looking at the grass, that even though it hadn't been burnt by the bushfires, it looked as though it had been singed, and that was just by the sun. And in terms of Australia, dealing with the current drought and the bushfires, we thought when we got to the Gold Coast that night, it really hit us, how powerful the pain of a lot of Australians currently is. And we thought we really wanted to do something as an organisation to be proactive and step up. We knew the Foundation for Rural and Regional Renewal was one of the very good foundations that take medium long-term support of rural and regional Australia very seriously. And so we've actually partnered with them to try to raise $1 million for both the people impacted by the bushfires and also drought. Now, we, as in the management company, is putting in, we'll match up to $500,000. So just go to frrr.org.au/WAM And if you want to donate money, or if you know anyone who wants to donate money, the quicker we can match that and put in $500,000, the better from our perspective. I think on the first day, I think we're up to $100,000. I haven't looked since then, but if you know anyone who wants to donate it yourself, as I said, the quicker we can match that, the better. So what I'd like to do now is I'd like to introduce Katrina Burns, who's the lead portfolio manager for WAM Global. Thank you.
Thanks, Jeff, and thank you all for your time. Current economic conditions are well summed up by a recent meeting I had with a German factory owner just outside Munich, who said at the moment the issue is less about underlying demand and more about confidence. In recent times, there's been a chorus of negative sentiment from journalists, investors, economists, and many CEOs, given this backdrop of trade wars, Brexit uncertainty, Hong Kong protests, and concerns around the general length of the cycle. But yet, on the other hand, we have a consumer who is largely employed and able to spend. And as Jeff talked about, we have highly accommodative central banks around the world. What we have seen in more recent months, however, is that public markets do seem to be becoming more discerning around valuation. This was really highlighted by the recent IPO, or failed IPO, of WeWork in the US. So this was a business that was coming onto public markets. In its last round of private funding, it had been given a valuation of $47 billion. And investment bankers were saying when it came on, it IPO'd, it would be valued between $43 and $100 billion. Now, this is a business that in 2018 lost $1.9 billion and didn't have a clear path to profitability. What we've seen is that as they tried to bring it on, public markets were not willing to give it this kind of valuation, and it's subsequently been written down to only $8 billion. We've also seen that IPOs that have actually come onto the market, such as Uber and Lyft, have fallen significantly once they've come onto the market. Again, these businesses don't make any money. On the other hand, we've got cyclical businesses that have been very out of favour because of trade wars and slowing global growth, which have in more recent weeks rallied strongly because of hopes of trade war resolution. Now, some of the valuations of these businesses are now at such levels that they're pricing in no chance of an economic downturn. For us at WAM Global, we're not wanting to make either of these bets. We're trying to look through the noise and find companies that are well managed, are growing, and are undervalued, and where we can see a catalyst that will change the valuation. I thought today I'd start by running you through two stocks which I've talked about in previous presentations, but which are now exiting the portfolio, to show you how our investment process works from acquisition to divestment. First off is a business called Entertainment One, which, as I said, I've talked to you about on previous occasions. So this is the UK-listed business that owns the kids' TV franchises Peppa Pig and PJ Masks. Now, the reason we really liked this business and why we bought it at the launch of WAM Global was because the media landscape around the world is fragmenting. We've got new players such as Netflix, Apple TV, Disney+, and that are competing with the traditional media operators. And so in this kind of environment, content is increasingly valuable. And content, particularly in the kids area, is of significant value because you can drive merchandise sales off the back of that content. What we also liked about this business is that in terms of monetizing that content, it was very early days. They had a huge opportunity in the US and in China. that was very early days in terms of getting that, terms of realising that value. What we've seen in terms of the results since we bought the stock is that the family business that owns that content has been growing over 25% a year. And yet the PE multiple, the price to earnings multiple of that business was only a 14 times multiple. So to us that seemed undervalued, and we saw big upside in terms of the earnings results, which, as we've seen since we bought the stock, they have delivered strong results. But what happened in late August was that the US toy and entertainment company Hasbro made a takeover offer for Entertainment One at a 31% premium to the share price, which the Entertainment One board have accepted as it's an all-cash offer. So the stock will soon disappear from the portfolio. The second stock I'll talk to you about is called Bandai Namco. Now, this is a Japanese listed stock. Again, playing with the genre, the idea that content is extremely valuable. They have a large back catalogue of content, and they're monetising that across video games, across toys and entertainment parks. Now, again, we thought this content was very much under-monetised. The Chinese video gaming market is growing over 20% a year, and this stock was also trading at a significant discount to its US peers. So we thought there was a valuation disconnect. We thought there was a strong earnings growth profile over the next few years. And we also thought that the balance sheet had huge optionality. It's very conservatively managed. It has a net cash balance sheet. And the management team themselves are very conservative in terms of forecasts. So we thought there was earnings beat potential. What we've seen since we acquired the stock is that they have had a series of strong earnings results. But the reason we're now exiting is that that valuation disconnect compared to its offshore peers has now closed. So from having been trading on a 14 times multiple, it is re-rated to over 22 times. And for us, those catalysts have played out, and we've decided to exit the position. Despite still liking the business, we just can't see as much upside as we did when we first entered the position. I'll now whip round in terms of the US, Europe and Japan and run you through a stock from each that we like and that we still see upside in, and give you some insights into what we're seeing on the ground in those places. First, in terms of the US. So we've spent a considerable amount of time in the US over the last year or 18 months. And one of the things that's interesting in the US, and on a recent trip, in recent months, we're in Nashville. And Nashville is booming. There's cranes everywhere, the roads are full, there's multiple jobs available. Amazon, for example, has just put 10,000 jobs into that city. And what this phenomena in terms of mid-tier cities is really, we're seeing this across the US. So in places like Seattle, New York, San Francisco, it's very hard to find workers given the strength of the US economy. And so a lot of corporations are moving to these mid-tier cities. There's been some tax incentives for them to employ people there, and a lot of them are moving there and employing the workers in these mid-tier cities. So this is really spreading out the recovery across the US, which we think is a real positive for the economy. To go back to why we're in Nashville, one of the core holdings in the WAM Global portfolio is a business called HCA Healthcare. So this is the largest for-profit hospitals operator in the US. They run 185 hospitals, 2,000 points of care across 21 states. Now, in the hospitals business, it really pays to have scale. So you get benefits in terms of procurement, in terms of dealing with the commercial payers or the insurers, and in terms of staffing. You also have demographics in your favour in the hospitals business, particularly in the US, where you do have an ageing population, where by 2035, 1 in 5 residents will be at retirement age. So all the baby boomers will be at retirement age, and you see an increasing use of the hospital system as people age. So we have demographics in our favour, we have a scale benefit, but what we also like about HCA is the valuation. So for those who know Ramsay and Healthscope in this market, the valuation, well, Healthscope's now been taken out, but Ramsay, for example, this business trades at half the multiple of Ramsay. So it's on a 12 times price to earnings multiple, and yet has been growing double digit over multiple years. I think since 2012, they've doubled the operating income of the business and bought back 18% of the shares on issue. For us, we see catalysts ahead in terms of earnings beats, and we also think that the market is undervaluing the capital management opportunity for the business going forward, given the free cash flow generation. If I turn now to Europe, now there's a lot of doom and gloom surrounding Europe, given this backdrop of trade wars and slowing global growth, because it is an export-reliant economy. But for us, that isn't all doom and gloom, and we can still find great businesses that have been able to consistently grow over the last few years. What we also see in Europe and across other Western economies is that if you look at the younger generation, they're increasingly valuing experiences over products. So one of the companies that we own in the WAM Global portfolio is a business called CTS Eventum. Now, this is the Ticketek equivalent in Europe. So their major markets are Germany, Austria, Italy, and Switzerland. And in those markets, they have between 65% and 90% market share. So they've grown consistently over the last few years as they've grown their market share. And also, as you've moved from buying tickets in-store to buying online, they've seen significant margin benefit, which has helped their earnings per share growth. Now, the company has done well and the share price has done well, but the reason we like the company still is that more recently they've announced a deal to acquire the biggest player in France, who has around 40% market share. But why we think this is exciting for CTS Eventum is that this business historically was owned by an electronics retailer who simply used this ticketing business to drive foot traffic into their electronics stores. CTS Eventum is a professional ticketing operator, and we think they'll be a much better owner of these assets and be able to drive significant synergies over the next few years. So we still very much like this business. Lastly, if I turn to Japan, Japan's an interesting market in that you still can find very exciting businesses that aren't well covered by the market, either by fund managers or by brokers. But you have to go digging. You also have this situation where the economy has clearly been sluggish for multiple decades, and so often if you find a business that has decent growth, it will trade on a valuation that is extremely high. So if it's a business that really has low growth and structural headwinds, then it might trade on a cheap multiple but not have that optionality on growth. For us, we're trying to find that business in between where it does have strong earnings growth potential over the next few years, but also doesn't have a valuation that's astronomical. The Japanese tend to be particularly conservative, so you do often find balance sheets that are net cash. I think the stat is that 41% of small mid-cap companies in Japan have a net cash balance sheet, so no debt. For us, one of the businesses we found that really ticked the boxes is a business called Kobe Busan. So this is the equivalent of Aldi in Japan. So they are a discount supermarket operator. They sell a limited range of goods that are at a significant discount to the regular supermarkets. And what's exciting about this business is that they've been able to consistently grow their same-store sales. Since 2014, same-store sales have grown 6 to 8%, and they've been able to drive margins up as they increase that percentage of private label product. It also has a conservative balance sheet and a management team that has been conservative over time in terms of their forecasts. It has generated over 25% returns on equity. And for us, why we still like the business, it was interesting in terms of that, John, as I said, around the companies not being covered. If I look back when we first invested in the company, there were no mainstream brokers covering it, and so it was very much under the radar. In the last few months, we've seen UBS and CLSA come out with coverage and strong buys, and the share price has gone up. But why we still like it is because of that optionality on growth still ahead of it. They can almost double the store base from here. So they have 840 stores today, and they think they can grow to over 1,500. So there is still a long runway of growth ahead. That's just a sample of the stocks that we have in the WAM Global portfolio. As I said, what we're looking for is really those well-managed, growing and undervalued businesses around the world. I will leave it there, and I'll hand over to Matt, who will run you through WAM Leaders. Thanks very much.
Thank you, Katrina, and good morning, everybody. Today I thought I would touch on a few topics. We'll look at the macro, what's driving stocks at the moment. Then we'll look at the Australian economy, how are we tracking? Then we'll look at the top 20 and some of the thematics we're playing at the moment and a few stocks at work. So if I look at the macro, I thought this was a great graphic to try and explain what's going on at the moment. We've got a lot of intervention. So central banks are intervening again, and that is why asset prices are going up. They're not going up because economic data is getting better. They're going up because we've got intervention. So the cost of funds has been going down, and the money supply has been going up. So even the last 12 months in the US, so we'll talk about the US because it's the main driver, the broad money supply has gone up by $1.2 trillion over the last 12 months. They're injecting a lot of liquidity in the market at the moment. And what this does is suppress volatility, which in turn pushes asset prices up. So that's why asset prices are going up, not because the underlying economic activity is getting substantially better. So for the market to go up higher from here, this activity by central banks needs to stimulate growth. We're of the view that it will happen, we will get growth, and it will come through in 2020. So there's this awkward period now for maybe a month or two where the data is slowly getting better, but it's really not going to get much better until 2020. And at the moment, it really reminds us of 2012 and 2016. So they say history doesn't repeat, but it often rhymes. This is very similar to 2012, 2016, where we had a slowdown in economic activity caused by a few factors. In 2012, heightened uncertainty. So you have the European banking crisis. In 2016, it was around Brexit and the US debt ceiling and US elections. So for the stock market or economic activity to struggle, you need heightened uncertainty. And in 2019, we've got this through trade wars. And back in 2012, 2016 as well, you had a high US dollar and very slow European and Chinese growth, the same situation we're in now. These were mini cycles and things improved. So that's what our underlying thesis is. You'll get an improvement in 2020. So this is how we're positioning the portfolio in WAM Leaders. We're pre-positioning for a turnaround in global growth. So our underlying assumptions, I talked about money supply, so we're going to say that increases still, so the Fed are doing it, and ECB will be commencing a new one shortly too. So money supply, big tick. That's very positive for equities. And if we get global growth back, what happens is the US dollar is very much a safe haven currency. So when you've got heightened uncertainty, you get a strong US dollar. So what we're saying is global growth will accompany a falling US dollar. So we'll position around this. This is very positive for emerging market exposures. Interest rates. So at the moment, we've got a fairly flat yield curve. So what that means is the short-term money basically costs as much as the long-term money. There's no growth or inflation factored into the world economies at the moment. Everyone thinks we're going to have a really hard time, no growth. We think you'll get a steepening yield curve. So when long-term money costs more, you can position yourself in financials. So that's another thematic we think will play out. And then at the sector opportunity, within the ASX, you can really look at resources, energy, and companies linked to emerging markets if this thematic plays out. So that's how we're positioning the portfolio at the moment. They're our assumptions. Now we look at the Australian economy, how are we doing? I think if this was a school report card, I think we'd get about a C or maybe a D even. The economic activity in Australia is quite low, so our economic growth is well below trend, sitting at 1.4%. So very slow environment in Australia. The RBA have dropped our cash rate down to 0.75 to try and stimulate activity. Inflation well below the RBA's target of 2 to 3%. I think it's been below for a decade, so don't worry about that one too much. They find it very hard to hit that target. Unemployment at a headline level looks pretty good, so everyone should feel good about themselves being employed, but wage growth is quite weak. So people aren't feeling really wealthy at the moment, and confidence is low, and that's translating into slower spending, which flows into the next slide. So this is a breakdown of some of the components of Australian GDP. And what we're looking at here is that dark green thick line, which is private demand, which is basically private spending. It's around residential spending, mining investment spending, and consumer spending. And what you can see here, there's been a big decline, and that is why the Australian economy is slowing. You've seen a big pickup in the trade surplus through resources, predominantly iron ore, and also government spending through education and health has ticked up. So really, to see the Australian economy going again, we need to get consumers going, and we really need some confidence reinstalled into the Australian economy, and that will come through a pickup in global growth, but also through some government policy. So Frydenberg is very much around delivering a surplus, which is a target they promised, and they're going to deliver that no matter what. But we think post the budget, they'll start spending again in a more meaningful manner, which will be a big positive for the Australian economy and hence a lot of Australian equities. In an election cycle, you don't spend year one because it has no real benefit for your re-election. You spend year 2 and 3, and I think that's the plan for the Australian government. So if we look at the portfolio, in WAM Leaders, we have about 84 stocks in the portfolio. This is just a snapshot of the top 20. They often contain large companies because they're more liquid and less risky, so we increased our weights in there. But we've got about 84 stocks in the portfolio. The thematics we're playing around resources, you can see there we've got BHP, Fortescue and Rio, and energy was another thematic we can play. If you get global growth picking up, we've got Woodside, Santos, and you don't see a few of the smaller ones, but we've got Oz Minerals, Western Areas, Beach Petroleum for more exposure there as well. And then we've got a lot of stock-specific stories around Challenger, around annuities getting better. You've got Brambles there conducting a $1.4 billion share buyback currently. And then you've got James Hardie, which has had a great run over the past 12 months, which I'll walk through later. So it's important that when you see the top 20, there is a lot more behind there. There's another 64 stocks that you don't get to see, and unfortunately we can't put them all up here. But that's just a snapshot of where we sit. You see there's some banks as well. We've reduced a lot of our bank weightings, thankfully, before they fell, and you'll see a very different top 20 going forward. So now I'll walk through some stocks that have worked. We were going to do stocks that didn't work, but unfortunately we don't have that many slides, so I had to keep it down to 2. So CSL, now I keep forgetting this, but 1994 was the IPO year, and $2.30 or $2.40 was the IPO price. Now trading at $280 just recently. So fantastic story. And I guess the real driver of growth at the moment is around very tight supply of their end product. So what happens is CSL collect blood, they fractionate it, and they get a product called IVIG, which is derived from blood plasma, and then they sell it onto hospitals and other specialist use. So what happened in the last few years is people haven't been spending money building out these collection centres where they collect blood. And CSL have been. So they've been expanding their collection centres, and now they have a very, very strong position. They're getting a lot of volume growth, capturing a lot of volume growth, because hospitals will try and order from other competitors and they're running out or can't have a ready supply. They're also getting very strong price growth. So we think over the next 2 to 3 years, this market will remain incredibly tight for CSL. So despite its very expensive valuation, we still like this stock. So it has worked for us. It's been a very important stock for us. But we think there's more to this stock if the market holds together, because if the market rolls over, these high valuation stocks will get hurt. But if the market holds together, this stock should perform very well going forward. And the other stock, I talked briefly at the start about the macro. So WAM leaders, we have to look at the macro a lot more because our companies are bigger and their earnings are more linked to the macroeconomic activity. Whereas in WAM Capital and in instances in WAM Global, their companies are a lot smaller and they can grow independent of the cycle. But a lot of our companies grow with the cycle and a little bit more. So that's what we have to look at the macro a lot more. So when we look at James Hardie's, he had a couple of tough years, James Hardie's. They had a few production issues. They weren't meeting supply in the US. So they make sidings for houses in the US. And the US housing market, as we know, was one of the causes of the GFC. It's been in a really slow and steady recovery phase post-GFC. We actually even haven't hit the medium average houses built every year in the US yet. That was running around 1.5 million. At the moment, it's running around 1.3 million. So with Hardie's, a tough couple of years, new management came in and he announced a $100 million synergy target, which was taking costs out of the business. So this got us really interested in the company. That's on the micro level. And then on the macro level, we had interest rates fall about 150 basis points, or 1.5%, from the highs 12 months ago. And what happens is when you lower interest rates, housing activity gets stimulated, and that's why we're really interested in Hardie's. So what happened is Hardie's, the new CEO came in, announced the cost out, the synergies. We were a little bit hesitant. We didn't buy the stock then. But then they reported and actually beat their earnings. So we became a lot more confident in the new CEO. He was delivering already. So we purchased the stock. And you can see there, it sort of bottomed around January of 2019, but we missed that first leg up around till July of 19 because we were trying to get confidence around new management. In hindsight, we should have gone in earlier, but it's easy in hindsight. And then what happened then is he beat earnings, stock re-rated, and then in the August result, James Hardie's beat earnings as well. So we were very confident. That's when we increased our weighting in the stock. Generally what we do is we have a weight, and then as we get more confidence around the story and we can see the catalyst around earnings upgrades, we increase our weight. So we increased our weight between August and the next quarterly, and thankfully at the next quarterly, they beat their earnings again. And they beat the consensus expectations and the stock re-rated. So the stock is trading around $28, $29 now. It's done a lot of its work. We've reduced our holding from 2% of the fund to 1% of the fund. But we still like the story. And again, if we look at the macro and the micro, they're all working in its favour still. So we still like this story. So that's it from me. I'll now hand over to Oscar Oberg, who'll run through WAM Capital for you. Thank you.
Thanks, Matt, and good morning, everyone. Now, I'm sure all of you have heard stories about how tight the banks have been in providing loans since the onset of the Royal Commission. I think one of the most ridiculous stories that I've heard is about a guy who worked in an office who every month used to buy a lotto ticket on behalf of his work colleagues. When he went to apply for a loan, the bank looked at his financial statements, saw the monthly lotto ticket, and concluded that this man had a gambling problem. I mean, what a joke. That's just crazy, isn't it? Now, we believe that the tightening of credit undertaken by the banks over the last 2 years has artificially slowed the Australian economy. We expect this to turn around in 2020 which will benefit a number of quality small cap companies that fit our investment process at WAM Capital and WAM Microcap. So today I'm going to talk about a sector that we quite like over the next 12 months, and then I'm going to talk about 4 companies that we've purchased over the last 6 months using our investment process, and each of these 4 companies will receive a positive tailwind from an improving Australian economy in 2020. So how bad is the Australian economy right now? Now this is a key question we've asked ourselves many times over the last 2 years, as we've seen sectors exposed to the economy such as retail, building materials and automotive get sold down in favour of high growth sectors of the market such as the technology sector, which we think is trading at an unsustainably high valuation. Now at the time of the election in May, the most expensive companies in the ASX had outperformed companies exposed to the economy by a massive 34% over the last 2 years. Now, it was at this point, at the time of the election in May, where we saw attractive valuations relating to companies exposed to the economy, and we believe that market expectations were very low heading into the August reporting season. Now, pleasingly, what we've seen over the August reporting season and over the last few months is companies such as JB Hi-Fi, Super Retail, and Bapcor have actually performed strongly and delivered better than expected results and pointed to a stronger outlook. So given it is now November, we must ask ourselves, so where to from here? Now, despite negative commentary that we keep hearing in the press, it feels like every day you're reading something that's negative about the Australian economy, we still remain positive. We think share prices increase. And one sector that we see value and see upside over the next 12 months is the retail sector. Not many murmurs here today, Melbourne. A little bit different in the other cities. Maybe you guys are all positive. That's good to hear. Now, retail traditionally has been a hard sector to invest in, and that's due to the following 3 reasons. Firstly, it's subject to changing tastes and preferences. Secondly, it's high fixed costs such as rent. And thirdly, of course, has been the emergence of online. Now, at Wilson Asset Management, when we're using our investment process to invest in the retail sector, we're looking for the following 3 types of businesses. Firstly, we're looking for a new management team that is looking to turn around a struggling business. An example here would be, of course, Myer. Secondly, we're looking for a business that has the potential to generate a large proportion of its sales in online. An example here would be Kogan or Temple & Webster. And thirdly, we're looking for a business that can generate a large proportion of its sales in offshore markets such as the US and Europe. An example here would be Domino's. Now, I'm sure a number of you can remember a company we talked about 12 months ago, a company called City Chic. Now, I'm going to use City Chic today as a case study to show you how we invest in the retail sector using our investment process. Now, please don't think this chart is what happens every time we invest in shares, but it's a good example. So when we first bought shares in City Chic, it was in February 2018 at the share price of 28 cents. Now, at the time, the business was in a turnaround phase. There was a new management team, and they were looking to sell assets given an over-leveraged balance sheet. Now, at the time when we bought shares, the business was trading at a discounted valuation of only 3 times on a price earnings multiple valuation basis, making it one of the most cheapest companies I've ever seen us invest in WAM Capital. Now, thankfully, what we saw in May 2018 was City Chic sold its underperforming brands to competitor Only B, and we shifted from the turnaround phase into the earnings growth phase. And this is largely because City Chic had over 20% of its sales outside of Australia and over 40% of sales in online. It's been a big beneficiary of Afterpay. So thankfully what we've seen is City Chic has upgraded earnings expectations over the last 18 months, and today the share price is around $2.70 a share, and it's trading the price earnings multiple valuation on our numbers of around 23 times earnings, obviously a lot higher than the 3 times earnings when we first bought it. And we still remain very positive on the outlook for the company going forward. So given the backdrop of an improving Australian economy in the next 12 months, we're looking to find the next City Chic within the retail sector. So over the next few minutes, I'm going to talk about 4 companies that we've invested in over the last 6 months that should receive a positive tailwind from an improving Australian economy. And each of these 4 companies have been invested using our investment process within WAM Capital and WAM Microcap. Now, the first company I'm going to talk about is a really boring company, but sometimes boring is really good, and the company is called Brickworks. Now, as you would imagine, Brickworks is one of the largest brick manufacturers in Australia. It has a small but growing United States business. Now, the first catalyst to buy shares in Brickworks came from our belief that market expectations in its Australian building products division were too negative. Now, what you can see in that chart, see in 2018, earnings peaked at around $80 million in this division. They're now down 30% in 2020. But what interests us is if you look at 21 and 22, you can see that earnings from the analyst forecasting stock are flat. Now, following 2 interest rate cuts, our feedback speaking to home builders suggests the outlook for building materials companies has improved quite a lot. So we expect those earnings in 21 and 22 will be increased over time, and this will benefit the share price. Now, the second catalyst to buy shares in Brickworks came from its consolidation of the United States brick industry. This brick industry is a lot larger than Australia, and is more fragmented. It has over 37 manufacturers compared to only 5 in Australia. So we see a great runway for growth for acquisitions for Brickworks going forward. So look, I can't believe I'm talking about a brick company as our top pick within WAM Capital at the moment, but look, very positive on the medium-term outlook for this business. Next company I'd like to talk about today is BWX, which we own in WAM Capital. Now, BWX is a manufacturer of skincare products, with its largest brand, Sukin, the #1 selling brand within Australian pharmacies. Now, the business has embarked on a series of acquisitions over the last 2 years, which has culminated in a big fall in the share price, around 80% to lows of around $1.30 back in February. Now, with the share price bombed out and no interest in the company, we thought it'd be a good opportunity to pay management a visit. And the catalyst we saw in BWX was a change in its chief executive officer. Now, under BWX's new chief executive officer, they're looking to reduce inventories to relieve pressure on the balance sheet. But most importantly, and this is what we get excited about, it's to take its high-performing brand Sukin in Australia into the United States. And based on our industry analysis, we believe this will be a success, and this will drive earnings upgrades in the stock going forward. Next company I'd like to talk about is Australian Finance Group, or AFG, which we hold in WAM Microcap. Now, AFG is the largest aggregation network for mortgage brokers in Australia. Now, we saw an opportunity to invest in AFG, and this is following the outcomes of the Royal Commission, and in particular, the ban to trail commissions for mortgage brokers. And this sent AFG's share price down over 30% to lows of around 90 cents back in March of this year. At the time when we bought shares in AFG at 90 cents, we're actually buying their assets at a 20% discount to their valuation. And on top of this, we're getting the operating business for free. Now, since this point in time, there's been a number of positive developments for AFG. We've had the proposed ban to trail commissions be lifted, but most importantly, and this is what this chart shows, you've started to see loan applications and approvals increase with an improving housing market. And we've seen this increase to around 10 to 11% in the September quarter. It's accelerated in October, and we expect it to continue to accelerate over the coming months. And again, this should provide earnings upgrades for the company. And now the final company I'll talk about today is Temple & Webster, which again we own in WAM Microcap. Temple & Webster is the largest online retailer in the homewares category in Australia. Now, despite a terrible initial public offering in 2015, the business has since recovered and posted over 40% revenue growth in the 2019 financial year. The start to this financial year has been more impressive, with this revenue growth accelerating to over 43%. Now, despite a tough housing market, we expect the shift from offline retail to online retail to continue to increase. And as you can see in the chart, penetration in the US and UK is currently around 15%, versus Australia at only 5% for the homewares category. Now, based on our work on the US and UK, we really see no difference to the Australian market. So we expect this penetration from 5% to increase over time, and this will benefit Temple & Webster. So given our views on an improving Australian economy, we see a number of quality small cap companies that fit our investment process at WAM Capital and WAM Microcap. So go out, do your best for the Australian economy, spend that little bit extra over the Christmas period, and remember to always shop at Myer. I'd now like to pass it over to our CEO, Kate Thorley, to conclude. Thank you.
Thank you, Oscar. And good morning, everyone. Thanks so much for being here. So this morning, you've heard from Jeff around how much the environment has changed in the last 12 months. We've got the central banks pumping more money into the system, and we have record low interest rates here and overseas. And you've now heard from each of our lead portfolio managers about how they're positioning the portfolios in your listed investment companies and some of the stocks that they currently hold in each of those LICs. And this is the real benefit to you as investors. We've got a team of 12 fund managers, very talented, incredibly passionate about investing, and they're spending an enormous amount of time meeting with management of well over 3,000 companies each year. And this has been able to deliver to you as investors over the last 2 decades. As a specialist in listed investment companies, we continue to believe that this is the superior structure to be managing your capital. It allows the fund managers to take a medium to long-term view when they're investing. Each of the listed investment companies can also pay you fully franked dividends, and we're able to smooth those dividends over time. And then finally, Jeff touched on this earlier on, they provide at times opportunities where you can buy a group of, or a diversified holding portfolio of very high quality stocks for less than what they're worth. And this is where we talk about when an LIC trades at a discount to what the assets are worth. And we see that as a real opportunity. And then finally, as a specialist in LICs, we know how important it is to engage with you as our shareholders. And the team and I absolutely love coming around the country twice a year to all the capital cities and to some of the regional areas to meet with you, to take on your feedback and to answer any questions that you may have. And we believe that this is really important, again, as a manager of LICs. Now, 6 months ago, you would have heard me talk about, as part of our Making a Difference, the launch of the WAM Academy. And I'm really excited that the first stage is now live. It's called WAM Academy Prep. And there is a brochure in your bags. And we'd love to get your feedback once you've had a chance to log on and do this first module. But we'd really love you to join us on this journey of improving financial literacy and this journey of really sparking a love for investing in the stock market. And we'd love you to share the WAM Academy with your friends and family and with your children and your grandchildren. Here's a short video of what to expect of this first module. So we'll be announcing or releasing, more modules over the course of the next year, but would love you to log on and let us know what you think. So a couple of weeks ago, for those of you who receive our weekly email, and if you're not signed up, please do so. You can let any of the team know your email address, but I sent out an email asking you what keeps you up at night, and we've taken on your feedback, and we're now going to have a panel discussion led by Jeff with each of the portfolio managers, and we're going to address some of those common concerns that are keeping you up at night. Thank you.
thank you. Thanks very much, Kate. And watching that video, I was thinking, it's a pity when I bought my first share, I hadn't seen that video. Then maybe some of the early pain wouldn't have been as bad. Look, thank you very much for your feedback. And as Kate said, anyone who hasn't signed up to our weekly email, please do. And then you guys own the company, and at least it's an efficient way we can communicate with each other. And please, a lot of people do give us feedback, and we think feedback is important, and various things that we've modified is because of the feedback you've given us. In terms of what does keep you up at night, and that was the question that you guys answered. Why don't I just ask the panel, and maybe start with Katrina, what keeps you up at night?
So for me, obviously, you as shareholders give us your capital to invest, and we in turn then go and find companies where we have management teams that we're entrusting with that capital. So for me, it's really that the management teams that we're entrusting with that capital are good stewards of it. And in this era of almost free money, we just want to ensure that those management teams aren't doing stupid things with it and value destructive deals, etc. So yeah, I'm really watching and trying to align with management teams that we think are good stewards of capital. So my concern would be that any of those companies really drop those standards.
Matt, what about yourself?
Apart from my 5-year-old and 2-year-old girls that keep me up every night, it would be around obviously performing. So we've got to perform for our shareholders, yourselves. So that's a big concern. But probably the real big concern for me on a big picture view is around the inequality of this central bank intervention. So central banks are intervening, and a lot of the rewards are going to asset owners, and the workers really aren't getting the benefit. So post GFC, there's been all this expansion of balance sheet, which has inflated asset prices, but economic activity hasn't really kicked through in a big way. So asset owners are winning at the moment, and the workers haven't really moved in a decade on an adjusted basis to their improvement in their wealth. So eventually there's a breaking point. Who knows when it is? Do we get there? Not sure, but it is a concern.
And Oscar?
Yeah, I'd say, given a look at a full suite of stocks across small caps and micro caps, it'd definitely be around valuations. We are seeing some silly things at the moment, and I think it came here 6 months ago, and we had that chart where we were comparing the most expensive companies in the ASX today compared to the most expensive companies in the ASX back in the tech bubble. I think I said at the time, Jeff, that it was pretty much at the same valuation. Well, currently today we're now 20% higher than what we were 6 months ago. So that scares me, given we see a lot of companies out there losing money that quite have huge valuations. So.
And from my perspective, what keeps me up at night? Well, actually, nothing does, because I'm a great sleeper. But in terms of if something did keep me up, it would really be the end of the longest bull market ever. And we all know after bull markets are bear markets. I mean, one of the positive things is bear markets are short, even though they're very painful. And to me, it's just how does that play out? And in terms of the shareholders, what keeps you up at night? And actually, before I go to that, after this, we'll open up for general questions and answers. And what we're going to do is, for the latter part of today's presentation, we will do for the first time what we've been trying in all the other capital cities and has been a great success, is buy, hold, sell. So I want you all to think of a company or a company that you want some feedback on, and you'll put your hand up and I'll point to you and you'll name that company, and we will either say it's a buy, hold or sell or no view. And I think we'll go for a world record today in terms of how many companies. I think in Sydney, I think we did 350 companies. So I think we can do a world record, but that'll be I just want you to think of the companies' names now that you want our thoughts on, and we'll do that a little later. But in terms of what keeps you all up at night, the number one concern, and maybe I'll start with Matt on this, was really the fear of an Australian recession. And obviously the last recession was Paul Keating, the recession we had to have, the Banana Republic. So it's been nearly 3 decades since the last recession. When do you think the next one's coming?
Oh, it's an impossible question, but we'll give it a go. RBA have cut rates 3 times. What happens in a recession is 2 quarters of consecutive negative growth year on year. So from here, I don't think we go into a recession unless the global economy falls from here. I don't think there's enough internally going wrong at the moment for Australia to go into recession. So it's really linked to the rest of the global world economies, because Australia is an open economy. We're an export-driven country. Our big trading partners are very manufacturing focused at the moment. So like China, Korea, Taiwan, Japan are really having tough times, and that flows through to Australia. So our expectation is no recession, global growth to improve, Australian GDP to improve from here. But if global growth fell off a cliff, it'd be really tough for Australia. We don't have much ammunition. Phil Lowe talked about maybe 25 basis points is the limit of our monetary policy, and then post that he'd step in with quantitative easing, which is basically the RBA will buy Australian bonds, trying to lower the cost of funds to get activity going. So we do have some ammunition left, but our base case is no recession. If we try and think of a recession point in time, it's when monetary policy gets tight. So whenever that happens, it could be 5 years away, 6 years away. As Phil Lowe said, he can't envisage higher rates for a long period of time.
Yeah. And Oscar, you're obviously seeing 2,500 companies on an annual basis. What are you seeing on the ground there?
Yeah, look, I think it's fair to say it's mixed. There's no doubt about that. But I think generally it just feels like there's a lot of fear out there at the moment. We talked about it in the presentation today. Like, you pick up the paper, it's always negative. The Australian economy, consumer sentiment's tough, business sentiment's tough. But I guess if you look at the fundamentals, employment is still fairly strong. Just house prices are starting to increase again. That traditionally has been a good measure for consumer sentiment. It's not like we're at an F, we're a C. So we can hold on to that, as Matt was saying in his presentation. But I think our greatest asset with Australia, we are the lucky country, is we're currently in a surplus. So if things do deteriorate, we do have our firepower. Like, compare that to Europe or something like that. Like, they've just got nothing. So if things do get weaker, the government can step in.
And Katrina, just on the second question, that's about, the concern was the geopolitical tensions globally, what's happening with Brexit, and also the trade wars. And I suppose the second part of that, will there be a trade deal done, this calendar year?
Yes. So in terms of the geopolitical noise, it's been very high for the last 18 months. As you say, there's been the Brexit issues with Brexit. You've had Hong Kong protests. Before that, you had yellow vest protests in France. And so there has been this backdrop of geopolitical noise, which is, in terms of when we see all the management teams, it does affect confidence. So if you're a CEO trying to decide whether to invest and you don't know what your operating environment will be like, then it does make it difficult to make a decision on where to deploy capital. So we think any reduction in that geopolitical noise would be really positive for the confidence of the management teams that we see. In terms of the trade wars specifically, our view is, you've got 2 superpowers, but you've got China really playing a 20-year game plus, whereas the US is operating on election cycles. So they've sort of got different time frames. And so yes, it is very possible that we will see a phase 1 deal by the end of this year. But in terms of huge concessions, we don't expect China to really concede huge amounts. Those big issues around IP, theft, state-owned enterprises, Taiwan, etc. I don't expect major concessions from China. Yes, in this phase 1 deal, we'll get some more ag purchases, soybean purchases, etc. But yeah, on those major sticking points, I wouldn't expect China to give major concessions.
Okay, and the interesting thing, the third concern was these record low interest rates, which we've all been talking about, and Matt, you just talked about, and I know you missed dinner with Phil Lowe 2 nights ago because we've been on the road. It wasn't a private dinner.
Private, 300 other people and myself here.
So with these low interest rates, that was the concern. How long will they be at this level?
Probably the key takeout, I'm not sure if you read his speech, the RBA published all the speeches from members, but he talked about, we previously thought the RBA wouldn't really cut rates further than they are now, because Phil Lowe always stressed about the ineffectiveness of monetary policy down at these levels. When you're pro-zero, cutting 25 basis points really doesn't do much more. But it was quite interesting on Tuesday night, he said 25 basis points is probably the lowest they'll go. So he's already talking about dropping another 50 basis points. So a lot of commentators are saying, hey, we're going to go there. They think we really will go down there. So everyone with their money in term deposits are probably going to get another haircut. So it's where do you put your money? Interest rates lower for longer. But then going forward, we expect global growth to pick up. And when growth picks up, central banks will be a bit slow raising rates because they're all very scared about squashing the recovery if we get one. So they'll hold on for a bit longer. So we're going to have low rates for a long period of time. And because of the amount of debt in the system, we saw last year when interest rates in the US went to 3.25% and the Fed were hiking, the markets just went bang and fell. So they're very scared about raising too fast. So they'll be slow raising, so lower for longer, and it's probably lower than we thought after Tuesday night's speech.
And while we've got you, Matt, and this is probably the crucial question for us all, as we're equity investors, and the fourth highest concern, which I was surprised, I thought this would it was my highest, is when does this record the longest bull market ever in the US, when does it finish?
That's another
just got to polish your crystal ball.
Yeah. So I'd argue we're in an artificial market at the moment. The economic data doesn't match the stock market. So what has to happen is the economic data eventually catch up to the stock market valuation, and that's where we're sitting now. We're saying that will happen, but it's not a guaranteed. So the stock market the bull market will live on as long as there's liquidity and low rates. As you can see now, you put liquidity and low rates in, the equity market says, I don't care about the economic activity. We've got liquidity and low rates and it goes up. So when liquidity tightens and interest rates go up, that's when the bull markets end, not on economic activity unless you get a severe recession, which we're not in at the moment. So it feels like the equity market will keep going up for this period of time.
And Oscar, have you got any more clarity on?
Clarity. Interesting word. Look, I think I talked about the expensive companies that we're seeing at the moment within the ASX. I think it's important to note that is really one cohort of the companies we look at. There's another large cohort, and it's actually around 40% of the small caps that we look at that's trading at really discounted valuations, and they're very cheap valuations, sectors such as retail, automotive, property developers, building materials. So I guess we're not seeing the same excesses, I think, than what we saw before the GFC. And I guess given our views that the Australian economy can improve and the global economy can improve, these parts of the market or these sectors should improve. So if we start to see that happen, perhaps we see inflation and perhaps we see interest rates increase as a result. So I'm going to say December 2021, Jeff.
Oh, okay. Oh, well, actually, Katrina, what about, I know globally someone's given us a date, haven't they?
So there's one of the investment banks, one of their economists thinks he has the ultimate crystal ball and is forecasting that at March the 3rd next year, at an S&P level of 3333, the market will top. So yes, I don't have that. I don't have that same crystal ball, but others claim to. From my perspective, I guess what the key watch point is really inflation, which we're not seeing at this point, and which really gives central banks a license to keep rates low. And the commentary they've given as well is that they will let it run hot. So we might even see, them because they'll be very reluctant, given what happened in December, to put up rates. And so given inflation is very low, they don't need to put up rates at this point, and I think they'll let it run longer so we can see the bull market extending from here.
Okay, and thanks, guys. And the fifth concern was really about, probably unsurprisingly, changes to the superannuation system. That came in number 5, and obviously, with what we've seen is the franking credit debacle. And I remember the last time we were here, it was the Friday before the election, and I think we're all pretty pessimistic. I remember that night, the election night. I said to my wife, "Hey, look, I don't want to watch the election. I want to watch a movie." Because I didn't want to see the bloodbath we knew that was going to occur. And just on that, just for clarity, we all know we've got an ageing population in Australia, and we all know that someone has to pay their taxes to support that population. And I'll put myself in your category. You guys, you've got to pay your taxes to support the older population. And we understand there has to be, that has to be sorted out, and the tax burden can't just fall on the younger generation. The older population has to pay some of that tax. I fully support that, and I fully understand that. I also fully support that Dick Smith, who says that he got $500,000 refund from his franking credits, shouldn't happen. I agree with all that. What I didn't agree with, or what we as an organisation didn't agree with, was the incredible inequality and the illogical way that Labor's proposal was set up. Where you could actually have 5 Australians that were, say, in their mid-70s that have worked all their life and done the right thing all their life, and then all of a sudden, of those 5 people that, say, had the same amount of money but in different structures, they would end up getting, some of them would be significantly disadvantaged. And if one person happened to be born a day after the other, so say back, one went on the pension in March 29th last year, then they would get their franking credits back. But if you happen to be born a day later and you went on the pension the next day, you missed out on your franking credits. So to me, it was, we were trying to be bipartisan, and it was really the inequality of it all. And someone asked me if I've been communicating with Labor on this. I was fortunate enough to be in a restaurant in Sydney, and Anthony Albanese was in the queue to buy his food. So I waited till he went up to the cash register, and I said, "Look, I'd just like to introduce myself. I'm Jeff Wilson. I'm very happy to talk to you about franking credits if you want." And he didn't look around at all. He just said, "No thanks." And they've got to understand that if the people that saw Labor did their assessment of the election and the election result, and myself and James McNamara, who runs our corporate affairs, we read through it in detail, and they hardly talked about franking. They talked about an enormous swing in the 25 to 34-year-olds in terms of their vote, and they totally missed the point. And the point was, we did a survey the week before the election, and of the people we surveyed, of the Labor voters, 77% said their children or grandchildren would change their vote because of what they were doing. And that's what the swing was. And to me, I just hope that Labor pay attention to the inequality and the unfairness of their franking proposal. And our view is it should be off the agenda for a generation. So, thank you for your support. We thought it was very unfair, and that's And it was interesting. It was the fifth most concerning thing from your perspective. Now what I'd like to do is I'd like to...